Private credit is the other worry today. There's about $1.8 trillion in private credit today, and a lot of it is in interval funds and funds that don't allow full redemption at any time. They might allow inflows, but not redemptions. And I think because of a few bankruptcies, highly publicized bankruptcies, one clearly related to fraud, this market has become unsettled. Just today, BlackRock decided not to satisfy the 7.9% in redemptions from its largest private credit fund. It only allowed 5%.
For months now, stress has been quietly building beneath the surface of one of the fastest-growing corners of the financial system, the private credit market. What was once considered a niche alternative to traditional bank lending has exploded into a roughly $1.8 trillion industry, fueled by institutional demand and wealthy investors searching for higher yields. But that rapid growth has also created a fragile structure, one built on loans that are often illiquid, opaque, and difficult to unwind when investors suddenly want their money back. Last Friday, those underlying tensions erupted into the open. BlackRock, the world's largest asset manager, took the unusual step of limiting withdrawals from one of its flagship private credit funds after a wave of redemption requests. Investors asked to pull out more than 9% of the fund's assets, but the firm capped withdrawals at just 5%, leaving a significant portion of investors unable to access their capital. At the same time, similar funds across the industry began facing mounting redemption pressure, sending shockwaves through private credit giants and triggering a sharp sell-off in asset manager stocks. To many observers, the moment raised uncomfortable questions. If funds holding illiquid loans suddenly face large redemption demands, can they actually meet them? And if they can't, what does that mean for the broader financial system, especially in a market now worth nearly $2 trillion? In this video, Cathie Wood, CEO and Chief Investment Officer of ARK Invest, breaks down what's really happening behind the scenes. She explains why stress in the private credit market has been building for months, how recent bankruptcies and rising uncertainty have shaken investor confidence, and why the latest developments could be an early warning sign for the global economy. So if you want to understand what this sudden private credit shock really means and what could come next for the markets, make sure you watch this video all the way through. And if you enjoy deep macro breakdowns like this, don't forget to like the video, subscribe to the channel, and share your thoughts in the comments below. Thanks, and enjoy the video.
I might be wrong on that 7.9%. There may have been requests for 9.3. In fact, I think that's right, 9.3%. They only allowed 5%, so roughly half. So there are a lot of nervous individuals who thought they were buying funds that were guaranteeing dividends in the 10 to 12% range, and they just felt safe. It was bond-like. But whenever you see outsized guarantees like that, 10, 11% dividend yields, when the treasury yield out there is 4%, you have to know you're taking some kind of risk. And the risk here is bankruptcies. Now, these companies have been used to adjustable rates. These interest rates go up with the Fed funds rate. But I think the problem now, since many of these companies started and or were funded around COVID, we're now in the 5 to 7 year window where they'll want to roll over the debt. And that's not going to be possible in this new world. Many of these companies are being disrupted by technology. SaaS is a great example. A lot of private credit and private equity firms started buying SaaS companies. Well, guess what? SaaS is being disrupted by the frontier models out there right now and by platform as a service companies like Palantir. So 11 to 12% dividend yields, those were not risk-free at all. And so here we're learning, again, an important lesson. Now, one of the things we have to ask as far as private credit goes is, could there be a systemic problem? Systemic usually involves the banking system, the highly leveraged banking system. And what we're learning is the banks are not, at least as far as we know so far, highly exposed to this area of the market. We can see this in the market as well from credit default swaps on individual banks. They have remained very low. So credit default swaps are insurance policies against something going really wrong with these banks. And I'll show you in a chart in a few minutes that CDSs are very well behaved in the banking sector. And in the high yield world, so this is junk bonds, if you look at the spreads of those yields relative to treasury yields, those are also very well behaved. And given the amount of drama taking place out there, you would think if there were to be a systemic problem, that those CDSs and the high yields would pick up on it. So we're feeling pretty good about that. Now, what's so interesting is non-farm payroll employment dropped 92,000. It was supposed to be up 55,000 based on all of the other employment indicators out there, which are all pointing up. So the ISM index employment indicators for both the manufacturing and service sectors, initial claims are quiescent, and just ADP reports have come. Now they're reporting weekly, and they've been up every week. And so this Bureau of Labor Statistics report is beginning to look a little ridiculous. We mentioned during the last In the Know that last year the non-farm payroll employment numbers were revised down for the year by 865,000. That took away employment gains for many months when we thought employment was stronger than expected. It took those numbers way down. Now, there is another statistic. It's called household employment that comes out on the same day. It's more reliable. It includes many more small businesses. And it, too, was down. It was down, I believe, at 185,000. Now, there was the Kaiser Permanente strike that impacted both. And there was very bad weather, so that's absolutely a consideration as well. But it does seem that employment is being revised down regularly, including last month. I think if I'm not mistaken, the downward revision was 69,000 for the last 2 months. So, it is getting to be kind of ridiculous. But the household employment number rarely is revised. They do, I think it's a 5-year revision, but they do revisions quite infrequently. And that number was revised down by 1.4 million jobs for last year. Now, it corroborates what we've been thinking. These downward revisions are partly a function of productivity growth being much higher than expected. And so what does it mean? GDP really is not being revised. So when you revise down employment, in order to get the same amount of GDP, productivity has to have increased. And so there is a structural shift taking place in productivity. And this is very important to our thesis that technologically enabled disruptive innovation is going to cause a step function increase in productivity. We would not be surprised to see it go from roughly 2%, where it has averaged for the last few years, up to 5%. And when productivity increases, inflation tends to decrease. So it's a Goldilocks world. And I think that's another reason the markets have been buoyed here. I think many people are surprised by the wall of worry that the markets have been climbing, especially since this administration started in January of last year. Of course, we went through tariff terror. We used to call it turmoil, but back then in April it was terror, and a lot of people were unnerved. And then we have the government shutdown, and now we have the war and a little bit of a government shutdown. So a lot of disturbances, but the market continues to power along. It's not a smooth ride, to be sure, but it has been hitting all-time highs. And I do think this productivity story is a very important reason.
Taken together, Cathie Wood's analysis points to two very different forces shaping the market right now. On one side, pockets of stress like private credit are revealing the risks that built up during the era of cheap money, especially as companies that borrowed heavily during the pandemic now face refinancing challenges in a higher rate world. But at the same time, Wood argues that the broader economic picture may actually be stronger than it appears on the surface, with technological disruption driving a major surge in productivity. If that trend continues, it could help keep inflation contained and allow markets to keep climbing, even as investors navigate a growing list of macro uncertainties. The broader macro picture becomes even more interesting when you look at the latest comments from Raoul, the founder of Real Vision and a longtime macro investor who closely tracks global liquidity flows. In a recent post on X, Powell argued that despite the pessimism currently dominating the crypto market, the bigger macro forces driving risk assets may actually be turning more supportive. Here's how he explained it. I can see how despondent everyone is about crypto, and the pure chartists are telling you it's all over, but I don't agree. Global liquidity is the most dominant macro factor in history, with a 90% correlation to Bitcoin and 97% to NDX since 2012. It is growing at around 10% a year and is not slowing. GMI financial conditions lead it by 6 months. They are still easing. The air pocket was US total liquidity, which was curtailed by the shutdown. It leads crypto by 3 months and is accelerating from its low 3 months ago. The business cycle is the key driver of earning and thus risk. It is accelerating. The ESLR is the mechanism by which banks can increase liquidity via credit and absorbing treasury issuance. This liquidity is rising too and will accelerate. Tax refunds land on bank balance sheets and add to propensity of credit creation and thus liquidity. What Powell is essentially highlighting here is that liquidity, the fuel that drives risk assets, is beginning to expand again across multiple channels. From easing financial conditions to bank balance sheet dynamics, and even seasonal factors like tax refunds entering the banking system, several forces are quietly increasing the amount of money flowing through the financial system. Historically, when liquidity rises, assets like Bitcoin and the tech-heavy Nasdaq 100 tend to respond strongly, but Powell believes the story doesn't stop there. In the second half of his post, he points to several additional catalysts that could further accelerate liquidity and risk-taking in the months ahead. China is accelerating and expanding its balance sheet. More rate cuts are coming in the US and will add to disposable income and thus risk-taking. Clarity Act will likely get agreed and add to flows. The wall of banks and asset managers wanting to use this technology is enormous, and this bill sorts that out. Stablecoins are accelerating, and issuance grew 50% last year and is accelerating. Volumes are in the trillions of dollars and are accelerating. We have the most supportive government for crypto ever in the US. Finally, the agents are coming and will hyper-accelerate. They are an entirely new TAM. The crypto market is still in fear and by most measures the most oversold in history. Weekly DMARC indicators would give a very solid base in 2 weeks. You can now get them officially on TradingView. Daily DMARCs are stack up too. Any weakness from here will complete the dailies and the weeklies, indicating full trend reversal potential. The risk factor is how long oil prices stay up. The next 2 weeks are the key focus. I think this all resolves positively. Higher. Taken together, Powell's argument reinforces the broader theme we've been hearing from macro investors like Cathie Wood, that despite short-term turbulence and widespread pessimism, the underlying liquidity cycle may still be pointing upward, and if those liquidity trends continue to strengthen, they could become one of the most powerful tailwinds for risk assets moving forward. At the same time, not everyone in the market is convinced the worst is over just yet. Prominent on-chain analyst Willy recently offered a more cautious take on Bitcoin, arguing that while a short-term recovery may be building, the broader cycle may still be in a bearish phase. Here's how he explained it in a recent post. Despite a local rejection of mid-70s, investor flows have been in consistent recovery since mid-February. Meanwhile, expected volatility, VIX, on equities is hinting at a switch to risk-on in the coming weeks. Bitcoin sold off way too fast in this early bear market, and current conditions are setting up to test mid-80s, which is the cost basis of short-term investors. This is not me saying the bottom is in. Bitcoin is solidly in the middle of its bear market through a lens of long-range liquidity. Typically, after fast downward flushes like we have had, Bitcoin likes to go sideways and mount a rally where resistance is tested, bull trap forming. Wu's interpretation highlights an important nuance in the current market environment. While liquidity indicators and macro signals may be improving, as investors like Raoul have argued, the structure of the market itself may still need time to reset. In many previous cycles, Bitcoin has experienced sharp sell-offs followed by relief rallies that test resistance levels before the broader trend becomes clear. From Wu's perspective, the recent stabilization in investor flows could support a rebound toward key levels, but that doesn't necessarily mean the larger correction has fully played out. And that contrast between viewpoints is exactly what makes this moment in the market so fascinating. On one side, macro investors are pointing to rising global liquidity, improving financial conditions, and accelerating technological disruption as powerful tailwinds for risk assets. On the other side, on-chain analysts are reminding traders that market structure, liquidity cycles, and investor positioning often take time to fully unwind. So the big question now becomes, are we seeing the early stages of the next major move higher, or just a temporary rally before the market finds its true bottom? Let me know what you think in the comments below. Do you agree more with Raoul liquidity-driven bullish outlook, or Willy Wu's warning that the bear market may not be finished yet? If you enjoyed this breakdown, make sure to like the video, subscribe to the channel, and turn on notifications so you don't miss the next deep dive into Bitcoin, macro markets, and the forces shaping the future of crypto.